Welcome to Show Me the Money with Michael Dirk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, brokers, investors, bankers, management companies, everyone that's in and out of the business and all facets of the trade, so that hopefully you can benefit if you're looking to grow your business, start your business, or maybe transition into something else. On this episode of Show Me the Money by Michael Dirk, we have Mr. Neema Ahadian. Neema is one of our top brokers with Marcus Millichap up in West LA and Hollywood, and his resume precedes him, so there's not much more to say. You'll learn a lot from one of the top veterans in our company, work in the LA market right now in the multifamily industry. So please stay tuned, and I think you'll like what you have to see here. This episode was sponsored by Pan American Property Management. It's a great company, management company based right here in California with over 40 years of experience in property management, operated and owned by Rick Hegler and his family, has been in the business and really execute at a very high level. They have significant construction background, repositioning properties from top to bottom, from small rehab to mid to a very, very heavy deep gut. I've seen them take properties down to the studs before. I definitely think that they would be a great asset for you and your property if you are looking for a new management team. Rick and his team at Pan American have been excellent for our clients over the years, and definitely strongly recommend giving them a chance to earn your business. Please check the show notes for more and give Pan American a shot. This show was also sponsored by Neema Ahadian. Neema is president and CEO of the Neema Group, a very powerful group at Marcus Millichap. They are investment brokers and have a full team up in our Century City office. And Neema has been one of our top performers across the country for many, many years. I definitely recommend, if you're looking for a BOV or just a consultant, or looking to potentially buy properties, expand your portfolio, or looking to trade out of assets and talk about the different moratoriums or things happening in LA County, no one would be better to talk to than Neema and his team. Again, very extensive background, very polished, experienced, and they will get right down to the point. He's looking at a long-term relationship rather than just a transaction. Again, give Neema Ahadian and his team at the Neema Group an opportunity, and I don't think you'll be let down. Thank you. Welcome to another episode of Show Me the Money with Michael Dirk. We have a very special guest today, Mr. Neema Ahadian. Neema, thank you for joining us today. Thank you for being on the show and taking the time. Neema is a Senior Managing Director of Investments at Marcus Millichap. He has been at Marcus Millichap for 23 years and is also the director of the Neema Group. He is recognized for his real estate experience with a specialization in multifamily investments in the Los Angeles area. In addition to being an essential resource to multifamily owners throughout Los Angeles and successfully representing both sellers and buyers, Neema has excelled in leading his clients through exchanges into different product types, including local and out-of-state offices, multifamily properties, retail and shopping centers, and single-tenant triple-net properties. Neema's previous apartment management experience, along with facilitating many successful multifamily investment challenges as investor faces. With his awareness and mindset, Neema is even better capable of finding opportunities and adding value for his clients. Neema also understands the importance of building long-term relationships with his clients, which is fundamental to his business and success. In order to best benefit his clients, Neema is not a transactional broker, as is apparent by the relationships he has cultivated over the years. Neema received his BA from Marshall School of Business at University of Southern California. Go Trojans.
Yep.
With an emphasis in international business from the Copenhagen Business School. He is a member of the National Multi-Housing Group and is an active in promoting landlord rights. Neema, welcome to the show.
Thank you.
Thank you for joining us. And a little bit for the viewers out there, Neema and I started the company about the same time, about 21 years ago. Yeah. So we've been in the trenches and through a lot of bumps and bruises, especially in the current market we're in today. So, jumping right into it, Neema. Sure. What does the last year look like for you and the team out there? What is transpiring out there and what have you seen?
So we're going through a couple of micro challenges that are unique to Los Angeles because we have a lot of anti-landlord legislation and sentiment. which is one of the challenges, including we still have, unfortunately, some COVID collections we're dealing with, where tenants have taken advantage of the system and found ways to prolong payments that have hurted getting financing for transactions.
Yeah.
So you combine that with the rising interest rates, the overall feel of where's the market, and the challenges that we're dealing with are we're still active, and our velocity is down maybe less than half of what we were last year, but we're doing much more work. There's a lot more involvement on our side to be involved in almost daily communication, not only with escrow officers, but our clients, the lenders, the loan brokers, because there's so many more objections in front of us today. We're really trying to understand what could come down the road and how do we overcome it in advance, because the number of challenges that we're having are more than usual. Mm-hmm. And a part of that is obviously the cost of capital.
Yes.
Which is a moving target.
Right.
But one
or
thing
the lack of capital too, I guess, in that instance too. I mean, I'd say 75, 80% of our lenders from this time last year are effectively on the sidelines or out of the market. So, and like you were talking about with the moratoriums and tenants not paying rent, some lenders just look at it as a vacant unit, and that really hurts, underwriting.
We had a 39-unit apartment building in Los Feliz that came on the market, and one of the interested parties that would have been a perfect buyer for the asset couldn't get financing. And he said, look, not only am I having a hard time on the debt side, I can't even get my investors to come in on a transaction today, given the environment. So that's one of the challenges where the asset and the pricing would have worked for this buyer any other day.
Right.
But today, given the challenges and also the fear of knowing of is this the right value? Is it going to be lower in 6 months? Should I just wait it out and see what happens? And that unknown, people are just like, we'll wait.
There's a lot of unknowns, and other guests on the show have talked about, the unknowns in the market right now, the uncertainty. And some of our largest clients that we've worked with over the years, though, have run in when everyone's running out. And like back in, say the subprime, when everything happened back in 2008, 9, and 10, some of our wealthiest clients went in 2009 and 10 and bought things and just took rates. Okay, you'll give me a loan. Okay, great.
Sure.
And they look like heroes today.
Yeah.
So in the face of adversity and animosity that's going on in the market right now, it's very challenging. But I still think that, I'm a believer long-term as an investor in real estate myself, buying for the long run and creating wealth and looking at, the long-term hold versus a short-term look.
Sure.
Working things out, maybe taking that bridge loan, maybe taking that higher rate of 1 or 2%. I know it's expensive in the short run, but in the long run, when you do have a motivated seller that's going to meet the market, I think the buyers who are in the market here over the next 12, 24 months are going to really persevere and do well. I don't know if you agree with that.
I agree with you very much so. And even there is that negative sentiment in Los Angeles, I see it as one of the best opportunities, because Los Angeles is a metropolitan city that won't change. We have employment, we have population, we have nightlife.
Diverse employment too.
Yes.
LA is probably the most diverse economic base probably in the country or the world. It's about as diverse as it gets as far as economics go, which is great. So it's not like just one industry. Okay, Hollywood goes down, the whole city goes down, or aerospace goes down. It's like it's so diverse now with that from people all over the world. That's what's so great about the city. And
we are seeing a lot of people starting to move back into Los Angeles. So the nightlife, the city life of wanting to be in a engaged environment is we're starting to see that again.
Sure.
And the rents will follow that.
Right.
So I am a big believer in buying in a market that will be around. And again, if you buy the right fundamentals and you're looking for strong locations with properties that can grow in terms of NOI throughout the years, it's a great time to be a buyer.
Yeah, and the weather, the climate, right? If more people are working from home and want a great place to live and want a great climate and something to do, and not going to the office every day, in Southern California is pretty tough to beat on that basis. So But some other people too, a lot of our investors too have really built their careers on equity appreciation. And
Yes.
now we're not getting that get rich quick overnight because interest rates are not crashing. Interest rates are going the other way. So now it's going to come down to separating the professionals from the amateurs.
Sure.
Is really what it is. And it's about managing through this cycle, not about equity plays. So that's a wholly different animal, and that's where the real operators are going to rise to the top, and the other people who were just playing the equity game are going to be
That is dead
hit.
accurate.
Yeah, so that's something that I think we're really going to see here in the next 12 to 24 months.
Just to comment on that, that's dead accurate. The guys that are the most active today in our marketplace are the operators, because you do have to be frugal and you do have to understand how to run apartment buildings. At the end of the day, you're a landlord.
Right.
And you're providing housing for somebody.
Right.
And you have to be able to control your costs if your rates are a little bit
Yes.
higher than you're used to.
Yes.
So, can you buy a building for 6 and sell it for 8? No. But can you buy a building for 6 in 12 months? Operate it, have a cash flow, figure out how to control your expenses while grow income, and
Yes.
really be a hands-on landlord.
Right.
Those are the guys that are still active and that are able to push properties during a challenging time.
Yeah, and a lot of investors today with fixed rates going to be rolling to adjustable periods,
Yeah.
insurance costs going through the roof,
Oh,
utility
insurance,
costs, management fees, labor costs. I mean, all these below the income line are increasing at such an exponential pace. And then having rent control, state of California, 5% plus CPI, LA, 3%,
Yeah,
right?
it depends on the city in LA, but yes.
Yeah,
between
and your
3
expenses are
4
going up
maybe.
way over 3%.
Sure.
So you're not creating equity. Your interest rates are going up. Your expenses are going up, and your income, for all intents and purposes, is relatively flat. So there's a lot of headwinds there.
Yeah.
So a lot of these owners and investors that are in the game, they've been very smart people over the years because they've been
Yes.
riding this wave. What is going to happen in the future? So I guess, maybe getting into that, down the road here, how do you stay informed about market trends and emerging opportunities? How do you advise clients in this time? People are looking at you, and you've built such a great resume, and you've had, so much success in helping your clients transition over the years. What do you tell them today? I mean, are you telling them to sit tight and hold? Are you telling them that they should sell some certain assets? Are you telling buyers, buy for the long run? What is your advice for a client? I know every situation is a little different, but in general, given the moratoriums of rent control and everything and the expenses that we're dealing with here, some people, in my opinion, probably shouldn't be real estate owners. And then other people, are going to be there for the long run.
That's a great question. So staying informed, first, on the macro level, I rely a lot on Marcus and Millichap and the information they're providing to us, and having detailed dialogue with MMCC and understanding what the debt market is really important, because that is the macro that you can't change.
Mm-hmm.
On the micro level, these questions and thoughts about how to control your expenses. We're getting down to, we just had a property that we were negotiating, try to get under contract, and I'm trying to get the buyer up on price. And obviously he's trying to get the best price. Mm-hmm. And we're hired by our seller to protect his interest. And we have a difference on the NOI. And I said, great, pull up your model. Let's go through it line by line. I haven't done this in years, Mike. Read me your first expense item. Insurance, I'm at $64,000. $64,000, why are you? And then we'll go through a line by line.
Right.
Well, utilities, I'm at this. Wait a minute. Why did you budget more than what we're getting? Well, because people are going to stay home more, and et cetera. So we're going through some of these line by line and trying to find out really where to push a buyer to.
Right.
And on emerging opportunities and market trends, a part of it is, since I only focus in core LA markets, we see a lot of the transitions in neighborhoods by just doing our inspections and our valuations and going to the buildings and
Sure.
Seeing what coffee shop popped up, and are they charging $2 for a coffee, or is it a $6 latte?
Right.
And you start seeing some of these places change neighborhoods.
Like, for instance, maybe give us some examples, maybe like in LA County, what just maybe 2 hot neighborhoods and 2 neighborhoods maybe to shy away from, maybe if you wanted to touch on those.
Well, Harvard Heights is a neighborhood that we sold a portfolio for of about 7 buildings. And we looked at it, and while we were doing our tours and inspections and all that, we noticed a few restaurants opening up that were the spillover from West Adams, which has really boomed.
Yes.
And it's between Koreatown, Hollywood, West Adams, and downtown. And then you started seeing some of these places open, and the rents slowly starting to follow as renters didn't want to pay some of those big premiums they were in these areas that have already gentrified.
Sure.
And Santa Monica, ironically, it's best real estate that most can hope for, but they had a real slump in rents for a while. And we're starting to see a lot of investors go back into that market because they feel like the
back into Santa Monica?
Back into Santa Monica because the cap rates have gone up.
Right.
And
I mean, I don't know how people manage that. They still have the vacancy control there, right? So if someone leaves, you can only raise rents by what they were previously paying.
No, in Santa Monica, it's not decontrolled.
They don't. Okay, got
it.
Okay.
So you can go to any market rent.
Okay, good.
So being able to really drive the streets and looking at these properties and locations is one way that we learn, and of course, talking to clients, being connected with the buyers and understanding. I mean, we always ask, why are you buying this? Mm-hmm. And sometimes, it's a tough question to ask, but what's your game plan here?
Sure.
Why are you doing this? And that's when you start to hear about really some of their motivations and a lot of the developments that are happening in certain neighborhoods.
Sure. And buying it for the long run, too. And you look at like SoFi Stadium, you look at that area 10, 12 years ago.
Yeah.
And that was a pretty blighted area. And all of a sudden, it's like, whoa, that whole area, blows up and changes overnight.
Yeah.
There's all these things and huge companies and corporations that can come in, whether it's city, government, or private corporations that come in and change an area. And then you bring in all the jobs and everything, too. There's all different things there. What areas would you maybe shy away from right now? Maybe just at least one area?
Where would we shy away from? Downtown LA is really challenging.
Right now it's challenging. Okay.
There's a lot of new product on the market. Their vacancy is high. They're giving concessions up to 2 months. I've seen a few properties.
Right.
They're giving
I've heard in certain cities like, Class A product up to 3 months of free rent in these Class A. Even downtown Nashville, where I'm primarily at most of the time, it, up to 3 months in some of these buildings. I think this is kind of short-term attrition. A lot comes out of the product or out of the market at once. A lot of supply comes on market, but, who knows? I mean, are people going to go back to work in downtown LA again is the question. And will people need to work close by, or are they going to work a little bit further out and get a better, maybe, quality of life, a little larger place to live in, where they don't need to be by a major hub to alleviate some of that commute? I guess that's the question we need to ask.
And one thing about downtown is that there is a really good amount of nightlife, restaurants, museums that attract people. But around 8 o'clock, 9 o'clock at night, it becomes a little bit of a different city downtown.
Right.
And the safety is what concerns a lot of people. So if you're younger,
do you
want to come down and see what unfortunately Los Angeles is going through? Right.
Families or single people, if you're not in crowds or whatnot, or equipped to deal with that kind of crime, it's an issue. Is that something you want to deal with and face? And so, again, it'll be creating opportunities for other people to come in and buy on these for the long run who can manage through it. Again, getting down to management or not, I guess, is really
especially on some of the bigger assets, as companies decide to leave a building or a market. We have a client that decided to exit Los Angeles, just as a market as a whole.
Okay.
And the buyer is an operator that owns 3 buildings within a quarter mile. And he'll, if there is a correction period, he can withstand it.
Yes.
But if you're operating from 1,800 miles east of the building, it's a little bit hard to.
Oh, yeah.
I'll see you there at 11 a.m. We'll figure it out together. You just can't do that.
Yeah. And managing properties, being boots on the ground, it's not something you can do on Zoom. And, you need to know what's going on. You need to see what's going on with the police. You need to see what's going on with schools. You need to see what's going on with the homelessness and crime. You need to have your boots on the ground there. That's imperative. And, Fannie Mae back in, the crash back in, 9 and 10, most of the buildings they had problems with were investors who were more than 100 miles away.
Really?
A lot of the properties. So the first thing that Fannie and Freddie and the agencies ask, how far is the operator away from the asset? So they want people, if it's a management intensive asset versus buying, say, a CVS or Walgreens or a Dollar General, where it's a non-management intensive asset, it's a checkbook club, or you go to your mailbox where you're not actually, managing it day by day. But on an apartment building, managing people, all the expenses and all the isms that go on around the building, you need to be close by. So,
and these vendors, unfortunately, they'll figure out that you're far from the asset. The pricing changes.
Right.
It's
the
like
$500 unclogged toilet. Yeah.
It's X.
Right.
Versus someone can do it for X minus 35%.
Yes, it's amazing. And Economies of Scale, we've had a lot of other guests on the show who have been, very large in the economies of scale that when they look to do that. And it sounds like the investor that you were just talking about to come in and buy in that neighborhood, when they're redoing and rehabbing a unit, it's $15,000 and they do a great job versus me who doesn't own in that property or that area or whatnot. And all of a sudden it's $30,000.
Sure.
So the economies of scale, managing people and labor, the 3 buildings next door are 20-unit buildings. That person's managing 60. Well, you know what? Here's another 20-unit building. Oh, now you're going to manage 80 units with the same person. You don't increase that pay versus me just buying that, getting that one person. So again, the economies of scale are very, very, important for someone.
And the migration of tenants. Sometimes they'll say, you know what? I have a 1-bedroom over here.
Yes.
That'll work for you. Or you want to upgrade to a 2 or downgrade to a single.
Right.
It
Smart.
happens a lot.
Exactly. Can you walk me through a deal you recently closed? What were the challenges you encountered? How did you overcome them?
Sure.
Maybe if you can touch on I know you chatted about one deal before, but if you could kind of chat about something right now that would kind of be.
We have, let me think. There's one that's actually, we hit a lot of hurdles. It's a 79-unit building, 2016 construction in prime Hollywood, East Hollywood, right across Netflix.
Nice.
And the ownership is based in Texas. They bought it from the developer right before COVID. Unfortunately, when COVID hit, a tremendous amount of the income went away due to just tenants not paying and loss of employment and the challenges with COVID.
And not able to evict them.
What's that?
And the tenant
couldn't
evict them.
They were pending those challenges for over 2 years.
Wow.
So this is a Class A building with 3 stories of subterranean parking, 4 stories on top, beautiful rooftop, amenities throughout, internet cafe rooms and gym and pools and saunas. I mean, the whole thing. But once the ownership reached out to us and said, hey, this is a challenge asset for us, let's look at it together. We did our BOV. Our first goal was for him to take the BOV to his lender and see if the lender would allow some kind of a forgiveness or cooperate with them. And the lender said, thank you, but no thank you. Our debt is on the building and we'd like to be paid off and we're not going to extend it and we're not going to forgive.
Was the property worth more than the debt?
So they purchased it for $37.8 million. Our valuation was in the low 30s.
Okay.
We decided to come to market.
What was the debt on it?
The debt was
roughly
around $26 million.
Oh, so there was equity in the deal.
Yeah.
Okay. All right.
We came to market unpriced. And I'll show you that the market's still vibrant. We had 15 tours, probably half a dozen offers.
Wow.
But then once you start filtering through the offers, and then once you start sharing the P&Ls, which were all over the place, Mike, this gentleman, because he's an out-of-state owner, 24-hour security at the building because of the homeless encampments that were on Sunset Boulevard that were starting to break in the building.
Wow.
So now a regular building that I wouldn't have an expense item for $80,000 a year, I got to include it in there. And then explain to the borrower and the buyer, well,
You don't need security. Just the seller needed it, right?
Yeah, the seller needed it because he's from out of state.
But you won't need it. It'll be fine. Yeah,
These guys are going to move in 2 days.
Right.
But it was a real challenge.
I bet.
And the market spoke with the offers coming in around the 30 million range. The best debt we can get was 11 to 13 million. So now, from all different kind of buyers and borrowers, looking at an awesome building at a yield that our cap rate was probably in the low fives. But you're putting 70% down, 65% down.
Right. You're not leveraging in, and your cap rate was lower than your interest rate, right? So
we had a lot. I mean, people were excited for the real estate, but once you start getting into it and understanding how to actually purchase it, and then how to deal with it, and then you have probably 14 tenants that weren't paying still, or that were on the tail end of their program.
Right.
Then you're really buying the building for year 3,
Sure.
Not year 1, not year 2, but year 3.
Right.
And we unfortunately lost most of the buyers, and we closed with the person under 30 million that could write a check. And there's not that many guys that could write a check for that amount, but they wouldn't finance it.
Right.
The buyer said, I'll purchase it, but I'm not going to use debt because there's no point.
Mm-hmm.
I'm negative leverage. I'll take over the building. I'll get control operations. I'll clean up the NOI. I'll rent vacancies of what I think we'll get. There's ways to improve the income as well as control expenses, and then he'll look in debt.
So did the buyer pay all cash, or they use a bridge? No credit. Okay.
All cash. He used a credit line that he had but no conventional lender. No bridge debt, nothing.
And that's when buildings have problems today. It really comes down to cash or a bridge opportunity, and that's where a lot of clients right now who are trying to buy properties right now, reposition if there is a value add play on the deals, putting that debt fund or a private money bridge. That's going to be imperative today to weather that storm into the next, I keep saying 12, 24 months, but I mean, who knows what that's going to be. But, it's priceless. I hope the seller realized what you did for them and how hard it is today and how hard brokers are working. Like you were saying, you're working harder, and there's so many brokers, including our team as well. I mean, we're working 10 times as hard for 50% of the volume.
Results, exactly.
Less than half. And that's reality of what's actually happening out there. If anyone tells you we're busy and we have so much going on,
sure. We're busy. But
exactly. Yeah, being busy and executing and closing deals
sure.
are a lot different. So that's why I just like to be very direct to the point and lay it out and what's actually happening and transpiring.
About the seller, I was going to just mention to you because I asked them, are you sure you want to do this? I mean, you're losing a lot of equity. Why would you even transact? Just take it off the market. Let's regroup. Come back in a year when things are better. And it's interesting because they made a decision to exit our market.
Okay.
They own another building in Portland. They exited Portland.
Okay.
Everything in Texas is doing groovy. And his motivation was really just to lower the amount of debt that he had on his books, so that he can be a better borrower for other assets.
Sure.
So for some guys, although it might hurt on one side, it's a win globally.
Yes.
So they're not easy conversations.
No.
We talked about this the other day. Where a lot of it is just talking it through with them and saying, you know.
We talked about, being a psychologist for clients or a psychiatrist, whatever you want to call it, but it's tough right now. And it's happened so fast and furious, over the past year, just to be able to talk to someone who's in the market so thick and thin like you are, right, and your team, and understand, and talking to so many principals and brokers and lenders out there to let people know that you're not alone in this, right?
Yeah.
This is a macro climate. This isn't like, just that
wrong.
building in Hollywood, you're the only person not making money in real estate today.
Exactly.
That's not the case,
yeah,
right? So
that's a good point.
People are feeling it. Some people just have their head in the sand. Some people are kicking the can down the road. Other people are waiting to pounce. Other people are making moves right now. People are selling, buying, still refinancing,
Sure.
albeit not to that level like we talked about. The
Sure.
volume is not there, but it still is happening, and deals will, the unfortunate thing I see some people, they're going to be in a position where decisions will be made for them. They won't make a decision, which I'm very concerned about. A lot of clients we speak to, and primarily we are always watching maturities when debt is coming due or it's rolling off a fixed period into an adjustable rate period. If they continue not to do things, they will be given their decision. And so that's why I always ask, and I'm sure you see it with your client base too, are people being proactive or are you just going to react? And God forbid if we see a big, huge amount of supply come to the market in the next 12, 24 months too, that's the other thing too, is managing that. And so increased supply is obviously going to compress values if interest rates, stay the same. If interest rates take a big dip, which some people feel that is the case, who knows? I mean, people ask us every day what's going on with interest rates.
I wish I knew.
I wish we all knew. Yeah. But, it's all we have is the information that's happened and the information we have today.
Yeah.
But with all being said, I don't think we're ever going to go back to the rates we had. I don't think we're going to have $5 trillion thrown in the market overnight for everyone to use and whatnot. So I think people have to become more in tune with the norm that here is the cost of a more normalized cost of money.
Yes.
The increased funds that were thrown in the market overnight caused somewhat of an asset bubble, and we need to manage around that.
Yes.
And so that's good to get your clients out on that basis and see, what do you want to do? It's nice to give them options today versus telling them the decision, in a couple of years to come maybe.
And the ostrich approach is the worst approach.
Putting your head in the sand.
Some of the smartest guys I've seen just prepared for it, and they'll take the blow, and then they'll regroup and move on.
Right. And it's amazing. Some of them don't even, we ask questions, when is your debt rolling on that 50-unit building in Hollywood? I don't know. Let me take a look at that. Yeah. Oh, wait, it's 2024, not 25. Maybe we should take a look at it. Or when it rolls to an adjustable rate loan, what is your index and margin? Well, I think it's SOFR. I think it's Treasury or CMT. That's just something right now that, and we say, well, no, it's based on SOFR. And SOFR today is in the mid fives plus your margin. Your rate you're going to roll to will be 8% today. Are you aware? Oh, and it's just, I think people are in stun mode right now.
Yeah.
So how does your property cash flow at 8%? And then interest only. If interest only goes away, the difference, even if the rate doesn't move, your payment changes by 40% approximately. So
we put together a little Excel, and I'm happy to share it with you and anyone out there. Just send me an email.
Great.
And we, for the clients that we work closely with, we put together an Excel of all those items that we need to know today.
Right.
When does your debt roll over? To what rate? How does it increase? What is it? What index are you using? When does the IO period go away? When is it due? Like all these things that you got to figure out.
Right.
Put it on an Excel. We put all their properties in there. If we have their debt, then we'll do it for them.
Yes.
And you don't have to decide tonight, but you got to look at it.
Right.
You just can't put your head in the sand.
Right.
And then some of those things pop out, and you're like, well, let's deal with this one today.
Yes. And I know you do a great job with your clients being a very senior broker in the firm, making sure it's good to point out all the variables and so that they understand what their options are. Again, it's the worst thing in the world to say, okay, well, Mr. or Mrs. Client, this is your only option. And that's the last thing we ever want to do. It's horrible. Yeah. One other quick point.
Sure.
Give me your high and give me your low in your career, if you can kind of touch on those two things. And on the low point, how did you bounce back from that? On
the low, we had so many lows. Which one do you want me to start with?
Start with one that really,
I have a recent one that's so small, but it's so frustrating because it still hurts like the first time. And even though, experience or whatnot and how many escrows we've closed, we still goof.
Yes.
And we had a client approach us on a 40-unit apartment building that he owned, and he owned the parcel next door that was a parking lot. And he recently bought it at a premium. Obviously, rates started changing, and he said, I have to get out. What's the best way to exit for the most amount of money? So we recommended to split the parcels, sell the building to an affordable housing operator and the lot to somebody else. Great. Took it to market, 2 separate buyers. We're moving quickly. Our escrow company sends the NHD report to the principal, but only the signature page. Doesn't include the report. And I goofed. I overlooked it.
Okay.
Didn't think it was a big deal.
Right.
3 days before the close. And I blame me because, we should have noticed that the NHD didn't go out. But 3 days before the close, the buyer says, I never got the report. Can you send it to me? I just signed off on it. We never got it. Sure. Here it is. It's in a methane zone.
Uh-oh.
So now on a site that he was planning on building, it changes.
Right.
You got to do methane testing. You got to
Right.
figure out what level of barriers do you have.
Sure.
So it was a low because, something so small becomes a big deal. An NHD report, it's like the basics of, opening an escrow.
Yes. And that's an excellent point. In this market right now, people in the business, especially brokers, any mistake will be magnified 1,000%.
1,000.
Versus 2-3 years ago, it's like, oh, under the rug, whatever. But from a lender's standpoint, when we're working on stuff and when you're working with principals, any little oversight becomes an absolute mountain.
And to your point, Mike, the challenge was I couldn't play the card of, well, take it or leave it, we'll go to buyer number 2. Right. I didn't have a buyer number 2.
Right.
We had one buyer on the table.
Yes.
And we had to service him to the finish line. And our seller and I were on the same page. And we said, we got to figure this out. It's my mistake. I'll correct it. But I couldn't play the hard card of, well, just move on because we didn't have an option B.
Right.
So that was a small but painful reminder of how diligent you have to be, especially in times that are more challenging.
Yes, details are the devil's in the details, right? That's what you hear. And then how did you bounce back from that? How did you, what?
So we got the methane report. The borrower who was getting debt also, because he was going to get a construction loan to build, said, I have to get a methane test. You got a methane test and it came back as level 3, which is expensive to incorporate into new development. And we did some homework. We reached out to a few other developers, and we discovered that it's shocking. The level of methane can change depending on the company you hire and how they test.
Right.
So we went back to the seller and said, we advise you to give the buyer 30 more days and let him find other companies to do the testing.
Sure.
They came back. They discovered the first test was done incorrectly. Came back at a lower methane level, which adjusted for a super tiny credit. We're talking under $75,000. And we came to an agreement that made everyone happy, and we closed on it.
Great. You made an excellent point. You go to one company for, say, methane testing. You go to an environmental company. You go to a property condition assessment. You go to an appraiser, and we deal with them all the time. And people just think, oh, well, that's what they said. That's what it is. And it's not. Please get second, third opinions if something sounds off. We've learned so much over the years where you have to question, second guess. These people are human, and sometimes they're not even working in the best ethics of business. Sometimes environmental companies right now, well, business is a little slow right now.
Let me push.
Oh, a little slow right now. Let's recommend a phase 2. Oh, okay. We'll start digging under the property and it could just be a bag, can of worms that unravels, and you got to really dig down and look at everything for what it is on the surface and make sure that, again, you're giving options and allowing everyone to make a good informed decision based on the variables. So great call on that.
That's what happened. The borrower said, how come all of your methane tests are coming high?
Right.
It's a little bit awkward that 5 different properties across Los Angeles all have the highest level of methane.
Right.
I'm going to do some more research. And then he went and did it, and that's how he discovered.
Smart. That's great.
Yeah.
Great. You've had a great career. What does it take to be a top-performing investment professional? What if you can tell some of the people out there maybe looking to get into brokerage or have been in brokerage? Obviously, you've been top 30, 40 investment brokers all over the country at Marcus Millichap. So, hats off to you for that.
Thank you.
What is it? what does it take to consistently do it day in and day out?
I thought about this just to give you a clear, concise answer. I think first and foremost, you always put the client's interest in front, no matter what. You have to think creative. You have to pull your resources. They're hiring you for a reason. We take the word fiduciary very seriously. We try to find solutions and always put the client's interest first. 2 is there's no magic. It's relentless hard work. I work a lot, and you work around the clock at times.
Right. Yeah, we talk weekends. I mean, you're on call. It's a career. It's not a job.
Exactly.
Yeah.
But with that, you have to find the magic of taking breaks and doing what charges your battery. Because if you show up empty, you're not good for anyone.
Right.
So as relentless and hardworking you have to be, I think it's equally as important to find ways to keep your battery as close as possible to 100% or at least in the green somewhere.
Right. Yes.
And just be a student. That little methane example that just happened, I don't know, a few months ago, is a reminder that you're still a student of the trade.
100%.
And is still a student of brokerage and life where,
Exactly.
I didn't
you
have
need to
the
be open
answer.
to that, yeah.
We got to figure it out.
Right. And that's what I was telling some other guests on the show. I mean, even doing financing for 24 years, I'm learning every day.
Yes.
Every day I learn. And that's what I love about the business as well. You in the same boat, right? I mean,
it changes.
Right. The real estate business is so dynamic and changing, exponentially on a consistent weekly, daily, monthly, yearly, whatever it is.
Sure.
Now it seems like by the minute, with everything going on. But that's great. And then last on a wrap for everyone, what's your forecast? So when you talk to the Neema Group and you do your pipeline meetings in the conference room, the next 6 to 12 months, what are you telling clients?
We, in the last 6 and 12 months, which is going to be similar to moving forward, is really keep focusing on operations and think on a global level what your goals are. I find myself, I can't even tell you how many times a week where we're in the middle of a transaction and the question comes, what are you trying to achieve? What's your goal? Well, what do you mean? We're talking about this. And I'm like, no. Forget this little thing we're talking about. What's your big picture? Are you trying to increase cash flow? Are you trying to make life easier? Do you want to move into assets that might not fluctuate as much as markets? What's our big picture here? Mm-hmm. Are we on the same page for your macro goal? And then if we are, let's focus on how to get you there.
Yes.
Because the speed bump is a speed bump. Mm-hmm. At times that's why you're so successful at what you are, is you navigate through markets and speed bumps. But as long as you keep the goal in mind and keep the client's interest in mind, what they're trying to achieve.
Yes.
It's, are you losing on this one asset in Los Angeles, which is not a good feeling?
No.
You're losing all your equity on a property. We're talking multiple millions of dollars. But it helps you lower your total debt balance that you have on your books, and you're more financeable when you find opportunities in the market.
Yeah, short-term pain for the long-term gain. I mean, that's really, I guess that's essentially what you're saying. I totally agree.
So we're just trying to help them focus on operations and their macro goal and what kind of a market we're headed into.
Got it. And I think my hat's off to you as well when you don't just work on a transaction, you look at the relationship and tell that client, a lot of brokers are like, we got to sell it now, get my paycheck and everything like that. You're like, you know what? Hey, for you to say, a $35, $40 million asset, maybe we just pause for a second.
Sure.
Let's look at it next year. That's someone who, again, the fiduciary responsibility, like you said, that's excellent. And that's what, some brokers do very well in the business, some don't. So I'm glad that obviously you have taken that stance and a big reason why you've been so successful in the business. Well, that's a wrap for another show. And Neema, I cannot thank you enough for coming down. Really appreciate it.
My pleasure.
Thank you for coming.
Of course.
I hope everyone enjoyed some words of wisdom here from one of the best brokers in the business and one of the best here at Marcus Millichap. So I just want to say thank you to everyone. Neema, thank you so much.
My pleasure, Mike. Thanks
for
having me on.
Have a great day. All right. Thank you. Take care.